Most people think that when money is already sitting in a bank or brokerage account, the hardest part is simply deciding how to spend it. But for many older Americans, that assumption can be wrong. A financial institution can sometimes delay access to deposited funds, pause a transaction, restrict activity, or even end the banking relationship. And the confusing part is that these situations are not all governed by the same rules. If you are retired, over 65, receiving Social Security, managing an inheritance, selling property, helping your children financially, or simply moving money between accounts, knowing the difference can matter enormously, because the real question isn't just, why is my bank holding my money? The better question is, what kind of hold is this? Which rule applies, and what am I entitled to? No. That distinction can determine whether you're looking at a routine delay measured in business days, a protective review that can last much longer, or an account closure that forces you to rebuild your entire financial system. Once you see the rules clearly, you'll understand why this matters more than most people. To realize, let's start by clearing up the biggest misunderstanding. There isn't one universal thing called a bank freeze. There are different situations that can look almost identical from the customer's perspective. You check your account, you try to move money, the transaction doesn't happen, you call the bank, someone tells you the account is under review, or the deposit isn't available yet, or the institution is ending the relationship. To you, it feels like one thing. Legally and operationally, it can be something very different. The first situation involves money you've just deposited, particularly checks. The transcript we're working from points to Regulation CC, the Federal Funds Availability Framework created following the Expedited Funds Availability Act of 1987. TEA's basic purpose was to establish limits around how long banks could delay access to certain deposited funds. That's important because the basic framework isn't designed to give banks unlimited discretion. Under the ordinary schedule described in the transcript, certain deposits become available quickly, while some checks can be subject to specific exceptions, and this is where one number becomes important. The transcript identifies $6,725 as the current large deposit threshold it is discussing. If you deposit more than that amount in checks on a single banking day, the portion above the threshold can potentially be subject to an extended hold under the large deposit exception described in the script. Now, don't just hear $6,725 and assume that every deposit above that amount automatically gets frozen. That's not the point. The important point is that a threshold can change the availability rules. Imagine a retiree receives an $11,000 check from an estate. The money is legitimate. The inheritance is legitimate. The person has done nothing wrong. But the deposit can still fall into a category where some of the funds aren't immediately available. That's exactly why this kind of situation can feel so unsettling. The customer thinks, why are they questioning me? But sometimes the answer is much less personal. The system is responding to the characteristics of the deposit. The transcript uses Clarence, a 77-year-old man who receives an inheritance check of a little over $11,000. To illustrate this point, his concern isn't that he did something wrong. Problem is that part of his deposit falls under a threshold that permits a longer availability period. And there's an important lesson here. A delay doesn't automatically mean suspicion. Sometimes it means you crossed a regulatory threshold. That's why one of the most useful questions you can ask a bank is not, why are you doing this to me? Ask, which exception is this hold being placed under, and can I have the written notice showing when the funds will be available? The transcript emphasizes that, for the availability hold situations it describes, the written notice is an important part of the process. That changes the conversation. You're no longer arguing about feelings. You're asking for the specific category, the reason, and the expected availability date. Now let's move to the second situation, because this is where things become much more important for older Americans. A deposit hold is one thing, A protective hold on a transaction involving money that is already in your account is something else entirely. This is the point where the transcript introduces FINRA Rule 2165 and the concept of financial exploitation of specified adults. The rule described in the transcript allows a brokerage firm, under qualifying circumstances, to place a temporary hold on a disbursement when the firm reasonably believes financial exploitation may have occurred, may be occurring, or may be attempted. And here's the part that matters if you're over 65. The transcript identifies 65 as the age threshold for the specified adult category in this rule. That means an older investor can fall into a category where the institution has specific authority to pause a transaction because it believes the customer could be the target of financial exploitation. Now think about why this rule exists. Imagine an older customer receives a phone call from someone claiming to be a family member. There's an emergency. Money has to move today. The person is told not to tell anyone. The destination account belongs to someone the customer has never dealt with before. From the customer's perspective, it may be a legitimate transfer. From the financial institution's perspective, it may look remarkably similar to a scam. That's the tension. The institution has to balance two competing risks. The first risk is allowing a legitimate customer to move their own money. The second risk is allowing a customer to be manipulated into sending money they never intended to lose. The protective rules are designed to give financial professionals room to pause a transaction when they have a reasonable basis for concern. The transcript describes the potential timeline as significant: an initial temporary hold and, under the circumstances described, an additional period that can bring the total to 55 business days. That's roughly 11 weeks rather than 55 ordinary calendar days. And this is where most people get caught. They hear temporary and assume it means tomorrow. But business days are not calendar days. And when you're retired, the timing can matter just as much as the amount. Maybe the money is intended for a home repair. Maybe it's meant to help a child with an emergency. Maybe it's part of a property transaction. Maybe it's simply a large transfer between accounts. The money can be completely legitimate, and the customer can still experience a delay if the institution believes there is a potential exploitation issue. The transcript's example of Willa illustrates this tension. She's 81 and wants to send money to her son during a difficult family situation. From her perspective, it's an ordinary family decision. From the institution's perspective, the combination of age, urgency, a substantial amount, and a transfer to another person's account can resemble patterns associated with the scams. And that's the uncomfortable truth. A protective system can protect people from financial exploitation while occasionally creating friction for people who are acting completely legitimately. Both things can be true at the same time. This is also why the idea of a trusted contact becomes so important. The transcript explains that a trusted contact is not supposed to receive control over your money. They don't get to move your funds. They don't automatically get access to your balance. They aren't given authority to make financial decisions for you. Instead, the institution can have another person to contact when it has concerns about a customer's situation. Think about what that changes. Without another point of contact, the institution may have a concern and very little information with which to resolve it. With a trusted contact, there is another person who may be able to confirm that the transaction was expected. That doesn't guarantee that a hold disappears, but it can give the institution another way to understand what is happening. And this leads to one of the most important strategic ideas in the entire discussion. Don't wait until there is a problem to organize your financial life. If you're over 65, or you're helping an older parent manage finances, this is the time to ask whether a trusted contact is on file with the financial institutions you use. And don't assume that because you added one somewhere, every institution has the information. The transcript specifically emphasizes that banks, brokerages, and credit unions don't necessarily share the same trusted contact information. Now there's another risk that gets far less attention. Sometimes the problem isn't that the institution freezes a particular transaction. The institution decides to close the account. That can be especially disruptive for retirees because a bank account isn't just a place where money sits, it's the center of a financial network. Social Security may arrive there, a pension may arrive there, mortgage or rent payments may leave from there, utilities may be connected, insurance premiums may be connected, subscriptions and other automatic payments may be connected. After decades, one account can become deeply embedded in someone's financial life. The transcript uses Nedra, a 9-year-old woman who receives a large amount of money from a property sale, to demonstrate this concentration risk. Her problem wasn't simply that a transaction attracted attention. Her bigger vulnerability was that nearly everything was concentrated at one institution. That's a powerful lesson. Financial resilience isn't only about how much money you have. It's also about how dependent you are on one institution, one account, or one process. If every dollar you need for the next month sits in one place, a temporary restriction can become a household emergency. But if you have a separate account at another institution with a reasonable cash reserve, the same problem may become an inconvenience instead of a crisis. This brings us to two very different approaches. The reactive household waits until something goes wrong. A deposit is held, and then they start searching for the rules. A transaction is stopped, and then they try to figure out what a protective hold means. An account is closed, and only then do they realize how many bills are connected to it. The strategic household works differently. They know where their funds availability disclosure is. They know how their institution handles larger deposits. They have a trusted contact where appropriate. They know which accounts receive Social Security or pension payments. They keep a record of recurring bills, and they maintain some degree of financial redundancy. The difference isn't intelligence, it's preparation, and that matters because retirement creates a different kind of financial pressure. When you're working, a delayed payment may be frustrating. When you're retired, a delayed payment can interfere with a carefully timed cash flow plan. If your monthly income comes primarily from Social Security, a pension, investment, withdrawals, or a combination of those sources, your margin for administrative disruption may be smaller than it was during your working years. That's why the goal shouldn't be to panic about banks. The goal should be to reduce single points of failure. So what can you actually do this week? First, find your bank's funds availability disclosure. Don't assume you know the policy. Read what it says about checks, larger deposits, new accounts, and exception holds. Second, if you expect to receive a large check, call the institution before depositing it. Tell them what the check is, where it came from, the amount, and when you expect to deposit it. You're not asking for special treatment. You're trying to understand the timing before you make a financial commitment based on money that may not yet be available. Third, if a hold appears, ask a precise question. Which exception applies? Then ask for the written notice and the expected availability date when applicable. Fourth, if you have brokerage or other financial accounts, ask whether you have a trusted contact on file. If you don't, consider whether there is someone you trust who could serve that role. Fifth, create a simple list of your recurring financial obligations. Know which account pays your utilities, insurance, housing costs, subscriptions, and other automatic bills. That list becomes extremely valuable if you ever have to move banking relationships quickly. And sixth, consider whether keeping a modest emergency reserve at a separate institution would make your household more resilient. This isn't about moving everything around. It's about avoiding a situation where one administrative problem can interrupt every part of your financial life at the same time. And there's a broader retirement lesson here. The strongest financial plans aren't necessarily the ones with the highest returns. They're often the ones with enough margin to survive an unexpected delay. A retiree with a carefully designed portfolio but no accessible backup cash may be more vulnerable to a short-term disruption than someone with a simpler financial structure and adequate liquidity. That's the difference between optimizing for a spreadsheet and optimizing for real life. And this is where the larger principle becomes clear. Your money can belong to you while access to that money is governed by rules, procedures, reviews, and timing. That doesn't mean banks are automatically acting against you. It doesn't mean every hold is suspicious. And it certainly doesn't mean every older American is going to have their account frozen. It means the financial system has different mechanisms for handling deposits, suspected exploitation, unusual activity, and account relationships. The mistake is assuming they are all the same. They're not. If a newly deposited check is being held, ask about the availability rules. If an outgoing transaction is being stopped because of a potential exploitation concern, ask who is handling the review and what documentation is available. If an account is being closed, focus on getting your funds and rebuilding your direct deposits and automatic payments deliberately, rather than waiting for problems to appear. And if you're helping an aging parent, don't just ask how much money they have. Ask where it is. Ask how many institutions they depend on. Ask whether someone trustworthy is listed as a contact. Ask what happens if their primary account becomes temporarily unavailable. Those questions aren't pessimistic, they're practical, because financial security isn't simply having enough money, it's having enough access, enough liquidity, enough information, and enough flexibility to keep your life functioning when something unexpected happens. So if you're retired or approaching retirement, take a few minutes this week and look at your financial system from the outside. Could you pay your essential bills if your primary account became temporarily unavailable? Would you know exactly who to call? Would you know what type of holds you were dealing with? Would you have the documentation you need? And would another trusted person know how to help if something unusual happened? You don't need to be wealthy to build that kind of resilience. You don't need a complicated portfolio. You don't need to predict the next recession, the next inflation report, or the next market move. You need awareness. Because the households that tend to handle financial disruptions best aren't necessarily the ones that never experience problems. They're the ones that have built enough margin that a problem doesn't immediately become a crisis. So here's the question I'd like you to think about. If your primary bank account became unavailable tomorrow morning, how long could your household continue operating normally? A day? A week? A month? That answer tells you something important about your financial resilience. If this explanation helped you understand the difference between a routine deposit hold, a protective transaction hold, and an account closure, consider subscribing. We'll keep breaking down the financial rules and retirement decisions that can quietly affect your money, without the panic, without the hype, and with a focus on what you can actually do about them. And if you're comfortable sharing, leave a comment with this. Have you ever had a bank delay a deposit or question a large transaction? Your experience may help someone else recognize what they're dealing with before it becomes a much bigger problem.